It's 11 p.m., you're scrolling, and there it is, the perfect pair of sneakers, the ones you've seen everywhere. You add them to your cart, but that final number, $200, $300, makes you hesitate. It's a little steep. Then just below the total, you see the magic button. 4 interest-free payments of $75. Suddenly it feels doable. Smart even. It's not $300 anymore, right? It's just $75 today. You click and that familiar rush of a new purchase arrives, wrapped in a neat bow of guilt-free satisfaction. That feeling of control, that's exactly what they want you to feel. But what if it's an illusion? What if that convenient little button isn't really there to help you, but to help them? Designed with precision to get you to spend more than you otherwise would. What is the real cost of that convenience? Today on GenShift, we're pulling back the curtain. This isn't another just make a budget lecture. This is a first principles breakdown of how the buy now, pay later BNPL machine is engineered to hook you. We'll dissect the business model, expose the psychological tricks they use to make you click, and show you the ripple effects they'd rather you never think about. If you're ready to understand the hidden architecture of modern debt and learn how to take back control of your wallet, you're in the right place. Make sure you're subscribed, and let's get into it. One, the BNPL machine, how it makes money. To understand the trap, you first have to understand the machine. Buy now, pay later, BNPL. Services like Afterpay, Klarna, and Affirm present themselves as a friendly alternative to credit cards. Their pitch sounds irresistible. Get what you want now. Pay over weeks or months with zero interest. On the surface, it feels like free money. But in finance, there's a golden rule. Free money doesn't exist. So if you're not paying, who is? The answer lies in a clever two-sided business model that earns from both ends of the deal. The first and largest revenue stream doesn't come from you, it comes from the retailer. When you use BNPL, the provider immediately pays the merchant the full amount minus a fee. This merchant discount fee is the BNPL industry's cash engine. And it's no small cut. While credit card companies typically charge merchants between 1.3% and 3.5%, BNPL fees range from 3% up to 8%. Afterpay, for example, can take 6% plus a 30C flat fee per transaction. Why would a business agree to such high fees? Because BNPL works like rocket fuel for sales. Research shows that offering BNPL at checkout can raise the likelihood of a purchase by about 9% and increase the average basket size by more than 10%. For merchants, those fees are essentially a marketing expense, paying to convert hesitant browsers into buyers and to nudge customers towards spending more than they planned. In other words, BNPL isn't just processing your payment, it's delivering you as a customer primed to overspend. This brings us to the second side of the model, the consumer. The so-called interest-free deal is conditional. It only holds if you make every payment on time. The moment you miss one, the illusion of free disappears. This is where late fees kick in, and they're not incidental. They're a deliberate, significant part of the business model. For a typical BNPL loan of around $135, many providers charge about $7 for each missed payment. That might seem small, but it stacks up fast. In some cases, multiple fees can pile on, or your bank may hit you with extra charges if an auto payment fails. The profitability of BNPL doesn't just get a boost from these fees, it relies on a predictable slice of its customers, often those least able to afford it falling behind. The industry's explosive growth was fueled by a regulatory loophole. By structuring their core offer as pay-in-4 plans or loans shorter than 62 days, many BNPL firms dodged classification as traditional credit under laws like the U.S. Truth in Lending Act or Australia's National Credit Code. This let them skip strict affordability checks and avoid the consumer protections banks must follow. In short, they built a multi-billion-dollar empire on a legal gray area. But that era is ending. Regulators in the US, UK, EU, and Australia are closing in. officially recognizing BNPL as a form of credit that demands oversight. This global crackdown is the clearest sign yet that the consumer risk isn't hypothetical. It's built into the very DNA of the product. 2. The Science of Seduction, why we buy with BNPL. The business model explains what makes BNPL profitable, but it doesn't explain why it's so psychologically powerful. Why does splitting a payment make us so much more likely to buy? The answer lies in behavioral economics. BNPL isn't just a financial innovation, it's a behavioral design innovation built to bypass the rational decision-making parts of our brain. The first principle it exploits is what behavioral economist Dan Ariely calls the pain of paying. Neurological research shows that spending, especially using physical cash, activates the insular cortex, the same brain region linked to physical pain and unpleasant emotions. This discomfort acts as a natural brake on spending, but payment methods vary in how much pain they trigger. Credit cards hurt less than cash because they're abstract. You're swiping plastic, not handing over bills. BNPL pushes this abstraction to the extreme. It is the ultimate painkiller for our wallets. First, it decouples the joy of consumption from the pain of payment. You get the dopamine hit now and deal with the cost later. Second, it breaks down a big, intimidating price into small, manageable chunks. A study in Sage Journals found that framing prices in these split terms lowers the perceived cost of a purchase. The brain doesn't register $400. It registers $100 today, which feels far less risky and much easier to justify. This plays directly into another powerful cognitive bias, present bias. Humans are wired to value immediate gratification over future rewards. It's the same principle behind the famous marshmallow test. Many people would rather have one marshmallow now than wait for two later. BNPL is the ultimate financial marshmallow. It delivers the instant reward, the sneakers, the concert tickets, the vacation today, while pushing the cost, the 4 payments, and the hit to your budget into a distant, abstract future. The system is engineered to trigger the impulsive, present-focused part of the brain and suppress the logical, future-oriented side that would normally say wait and save. The results of this psychological design are well documented. Research from Harvard Business School and the Journal of Marketing shows BNPL not only increases the likelihood of purchase, but also boosts the amount people spend. A LendingTree survey found that 2/3 of BNPL users admitted to spending more than they otherwise would have. This fuels a dangerous cycle. By making small to medium debts frictionless, quick, and seamlessly integrated into online shopping, BNPL normalizes borrowing for everyday consumption. It reframes what should be a serious financial decision into just another checkout option. No different from choosing standard or express shipping. For Gen Z and millennials raised in a world of one-click purchases and seamless digital interfaces, this normalization of debt is especially powerful and risky. 3. The silent debt, how BNPL becomes a trap. The psychological design of BNPL makes it easy to say yes to a single purchase. The real trap is sprung when those single, harmless decisions begin to multiply. This is when the convenience of buy now, pay later turns into the heavy weight of silent, creeping debt. Imagine this scenario. This week, you buy $150 sneakers. The first fortnightly payment of $37.50 feels trivial. A few days later, you see a $200 jacket on sale. Pay in 4 makes it just another $50 payment. Then your favorite influencer drops a link to a $400 tech gadget. Another $100 payment. Individually, each payment feels easy to manage. But these plans don't run in sequence. They run in parallel. Before you realize it, those small, staggered debt streams merge into a river. Your fortnightly outgoing isn't $37.50 anymore. It's $187.50, draining your account every 2 weeks. This is a phenomenon known as loan stacking, and it's how small debts quietly snowball into major financial problems. Data shows this isn't a hypothetical risk, it's the norm. In 2022, the average BNPL borrower in the US took out 9.5 separate loans over the year, and nearly 2/3 had multiple loans active at the same time. It's no surprise that delinquency rates are highest among the youngest users. A 2025 survey found that a staggering 51% of Gen Z BNPL users had missed at least one payment in the past year. The consequences extend far beyond late fees. One of the most insidious parts of the trap is the impact on your credit score. Historically, many BNPL providers didn't report on-time payments to major credit bureaus, so even if you paid diligently, it often did nothing to help build a positive credit history. However, if you default and your debt is sent to a collection agency, that negative mark will absolutely appear on your credit report, potentially damaging your score for years. Even as some providers begin reporting payment data, the very nature of multiple short-term loans can lower the average age of your credit accounts, which can also negatively affect your score. This is the revenge of your future self. The financial stress created by this accumulating debt is real. Studies from Stanford and the Federal Reserve show that BNPL users are more likely to incur bank overdraft fees and carry higher balances on high-interest credit cards, sometimes even using them to pay off BNPL loans, a classic debt spiral. This financial distress is directly linked to poor mental health, causing chronic anxiety, depression, and stress. But you are not powerless. Arming yourself with knowledge is the first step to disarming the trap. The solution is conscious financial decision-making. First, strictly limit your use. A good rule is to have no more than 1 or 2 BNPL plans active at any given time. Second, before you click buy, budget for the full purchase price. If you don't have the total amount in your account today, you can't truly afford the installment plan. Third, link all your plans to a single debit card so you can see the total outflow and avoid using a credit card to pay off BNPL debt at all costs. Finally, practice mindful consumption. Implement a 24-hour cooling off period before any non-essential purchase. This gives the logical part of your brain time to catch up with the impulse, breaking the cycle of instant gratification. Conclusion. So, buy now, pay later is not a neutral tool. It's not just a button at checkout. It is a system meticulously engineered with behavioral psychology to lower your defenses, exploit your cognitive biases, and increase your spending. It thrives in the gap between the immediate pleasure of convenience and the delayed pain of consequence. The price of this convenience is your financial awareness, but knowledge is your shield. By understanding the mechanics of the machine, you can beat the machine. Don't let your financial future be a product of someone else's design. Take control. We want to hear from you. What has been your experience with BNPL? Is it a helpful tool or a hidden trap? Let us know in the comments below. And for more deep dives that empower you to navigate the modern economy, make sure you subscribe to GENSHIFT. Stay smart, stay skeptical.